Hi, everyone. I'm Mike Pacito with IM Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures Strategy ETF, ticker DBMF. Well, we're halfway through the year, and to say it has been a unique 6 months is an understatement. When you think you've seen it all, the market comes up with a new storyline and twist you'd never bet on happening. Equally unique has been the incredible dispersion we've seen this year in managed futures strategies. The bar chart you're looking at here is the year-to-date 2025 performance of every strategy in the Morningstar Systematic Trend category, both mutual fund and ETF, with a track record going back to at least the beginning of the year. The SocGen CTA index is in there too. Now, first off, the dispersion between the top and bottom performer in the space is over 33%. This is truly historic. I haven't checked, but it's doubtful that most asset classes and investment categories have seen this kind of variance. Many established brand name managed future strategies have been badly hurt by the unprecedented whipsaws of markets this year, alongside their reliance on complexity and more volatile, esoteric underlying holdings. Now, second, as it pertains to DBMF, we believe this year further makes the strong case for replication and simplicity. DBMF has outperformed both the Morningstar category and the SocGen CTA index by over 400 and over 700 basis points respectively this year, which we'll delineate further in the video. But there's another really interesting thing in this chart. Notice that the Morningstar ETF peer group median did much better than the Morningstar mutual fund peer group median. And most of the ETFs in this space are much simpler in design and lower in cost than their mutual fund peers. Food for thought as our business continues to evolve. So with that set up, this month's update is called a repeatable investment process with structural alpha around efficiency or consistent index plus performance while avoiding blowups. It's a long title and it's a bit of an homage to Dr. Strangelove and the inimitable film director Stanley Kubrick, who was born this month in 1928. With that one, Andrew, I hand it over to you.
Thank you, Mike. That was a new twist on the intro. Thank you for that. So last month, I said the markets had liberated themselves from Liberation Day, and by the end of June, as Mike mentioned, they were decidedly risk on. Granted, there's been a lot of positive news. The economy is strong, the AI frenzy continues, and we have this pregnant pause on the trade war front. And lastly, the war in the Middle East, which I think a lot of people thought would escalate, did not. So equities staged a historically fast, bungee-like rebound from the lows. That said, it does feel a bit like the market is ignoring some big risks. For instance, whether we get a bond market tantrum, a re-escalation of trade wars after the pause ends, or a new flare-up in the Middle East. In any case, we'll have to wait and see. In any event, the last bullet point is about the evidence-based view on replication. I'm going to hold off on this until the next slide, but first performance. On the left side of the page, as Mike mentioned, you can see DBMF rose 2.7%, well ahead of both the SocGen CTA index here and after the hedge fund index in the Morningstar category. Now we'll drill down on this in 2 pages. But first, next slide, please. So there's been an important shift in thinking about replication. As you'll see in the data, you really cannot make the argument anymore that replication is a cheap knockoff or an oversimplification or excessively risky. Rather, replication is now viewed as a repeatable investment process with structural alpha around efficiency. In other words, we're picking up on the same signal that drives returns and alpha generation of the leading hedge funds that comprise the SocGen CTA index, major themes like the direction of interest rates. And we're seeking to implement those signals with far greater efficiency through replication. Now, we will be expanding on these empirical conclusions in upcoming Zoominars and webinars, so please, I hope you'll be able to join us. And with that, let's move to the next slide on year-to-date performance. So as Mike covered, the first half of the year marked one of the best periods of outperformance relative to active managers. Here's a line chart that shows the performance versus the SGCTA Morningstar category of 40 active funds and the Bloomberg US Ag. Now, this clearly has been a very, very difficult period for the space, but what is notable that other than a brief period of underperformance in March when the euro spiked, DBMF has been able to avoid the major drivers of losses across the space, which in many cases have been compounded by statistical innovations like vol controls or more esoteric and illiquid markets. Now, the past year or so has been a good reminder that alpha drivers, quote unquote, can generate negative alpha, including in periods when you hope or expect them to help drive returns or mitigate losses. Next slide, please. Now, turning to our inception to date performance, DBMF has outperformed the hedge fund index by nearly 300 basis points per annum and tripled the returns in the Morningstar category over 6+ years. Note that over this period, we've made no changes to the model or instruments that we trade. And this is what we mean by a repeatable investment process with structural alpha. Next slide, please. Here's our slide on volatility adjusted positioning. The green bars are the volatility adjusted exposure of our 10 futures contracts, and the red dots are positioning at the end of March. The obvious conclusion is that, well, the world changed a lot during the second quarter, and so CTAs adjusted their positioning, which flowed through to our portfolio. The broad positioning is that we are now aligned with a somewhat more growth-friendly worldview, modestly long commodities, equities, and a yield curve steepener. In contrast to earlier this year, we are now short the US dollar against the euro. And now for year-to-date contribution. As noted last month, the story this year is relatively simple. Long gold was the big winner, while short the euro was the big loser. Now you can see the choppiness in other markets, which shows up as modest gains or losses across all the other positions. Hence, we ended the first half flattish, which I consider to be actually a major victory given the treacherous market conditions. And with that, I'll pass the baton back to Mike.
Thanks, Andrew. So let's wrap it up here with long-term performance numbers for DBMF. Annualized return since inception, including the month that was June 2025, is now 6.69%, ahead of the SocGen CTA index by 325 basis points annualized, and ahead of the Morningstar systematic trend average by over 440 basis points. And long-term outperformance against the traditional diversifier for equities, that being bonds, as represented by the Bloomberg AG, remains well intact, DBMF outperforming by over 540 basis points annualized. So with that, thanks as always to our clients and to our prospective clients for your confidence and your interest in DBMF. If you have more questions about the strategy, would like further information or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com.